Welcome to the latest episode of our podcast series for financial advisors. Today's episode is Why AI Matters Now, how a $1.5 billion RIA is building the firm of the future. It's a conversation with Ryan Belanger, the founder and CEO of Claro Advisors. I'm Louis Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
Artificial intelligence has quickly become one of the biggest topics in wealth management in the world. Almost every firm is experimenting with new tools, looking for ways to automate tasks, improve efficiency, or help advisors serve clients more effectively. But what if AI isn't just another technology to plug into your business? What if it becomes the foundation for how your business is built? That's exactly why I wanted to have Ryan Belanger on the show. Ryan is the founder and CEO of Claro Advisors, a $1.5 billion RIA that's taken a very different path than most firms in the industry. Rather than simply adding AI to an existing tech stack, Claro acquired a fintech company and is building its own AI-native operating system designed specifically for advisors. What's interesting is that this isn't really a conversation about software, it's about strategy. Ryan has consistently gone against the grain, from leaving Morgan Stanley to launch an independent firm in 2012 before it became commonplace, to recruiting younger advisors when others chased established producers, to betting that proprietary technology will become one of the biggest competitive advantages an advisory firm can have. If AI is going to reshape wealth management, and I think it will, the firms that benefit most may not be the ones using the most tools. They may be the ones rethinking how the entire business operates. Ryan shares what that looks like in practice, what he's seeing from advisors today, and why he believes the next generation of advisory firms will look fundamentally different from the firms we've known over the last 2 decades. There's a lot to cover, so let's get to it. Ryan, thanks for joining us today.
Yeah, nice to see you.
You too. Good to see you again. For those who aren't familiar with you and your firm, Claro, why don't you walk us through your background and how you found your way into the industry to set the table?
Yeah, sounds good. So background was after college, I got a job at Morgan Stanley. I'd done an internship while in college, and that gentleman, Morgan Dewey, said you should look at Morgan Stanley. So I applied, got a job immediately, and just a couple weeks after graduating, I began as a financial advisor in a training program at Morgan Stanley and spent a good amount of time there and was able to develop skills necessary that really I had all along just growing up. A lot of entrepreneurial spirit, I think, is important in this business, how to relate to people, some competitiveness. And I just happened to luck out and get into a profession that rewarded some of those skill sets.
I'd say it was the right choice for you. So I think you started at Morgan Stanley in 2004. You were 21, 22 years old, just cutting your teeth. But then the financial crisis happened a handful of years later. So what was it like being a relative newbie and seeing client accounts falling, the world crumbling every day? What did living through that crash teach you that's shaped how you've built your business or served clients now?
I did learn a tremendous amount at Morgan Stanley, and I do still tell people if they're looking to start at a big shop with big training programs and resources and really try to figure out what you like, and then you can kind of go off and get more specialized. But I do feel like it was a great place to get trained. They would post how many cold calls we were making every day. So on the board every morning, you'd walk in and say, okay, where did you fall? And I'm a competitive person, and I just want to make sure I was kind of first every single day. So it was those type of things that really propelled me to keep interested in this business, but also see the benefits. It's really hard to get clients. What people underestimate the most is to build a level of trust with someone that they'll allow you to manage their retirement nest egg. Is it takes time. And I was 22. I looked really young. I had no experience, but I was fortunate to have two great mentors at Morgan Stanley. A gentleman named Todd Wetzel. He was brilliant at developing relationships, really caring for people. And then the gentleman that I had done an internship with went to Morgan Stanley as well. And he allowed me to work on some small accounts and really kind of cut my teeth with some customers. And I was very fortunate to have done that. But you had asked about the crash. And I think what I learned from that, when people were literally weeping when their account values were down by 50, 60%, was that money is really emotional. And you have to understand how much it means to people. It's not just a number on a screen. So having some empathy towards someone who's really in a period of distress is now a critical skill that those of us have been around for this long understand. And there's a whole generation, Lewis, of advisors that have never experienced a real bear market. And I do fear for them at some point, because when you go through that, it really changes the perspective that you have. But for me, it happened, I was 4 or 5 years into the business at that point. So I'm thankful that it happened, just for my own personal development, and I'll never forget it.
Yep. Things have a way of happening for a reason. And then the best advisors, best humans, they learn from them and they're better off for it. You're very much right. I like that perspective about how the empathy around the emotions of money is something that you still carry and wear as a badge of honor today. So you left Morgan Stanley in 2012. I think you're 30 years old, I read. I mean, that's very young to consider leaving a firm like that, nonetheless to go independent. When in 2012, it wasn't like everyone was going independent. There weren't as many infrastructure providers or tech vendors or as much capital available as there is today. Definitely wasn't a path that was as well worn as it was. So 2-part question. What pushed you to leave the firm, presumably without a huge book of business? And second part, how do you think about risk and reward at that age?
Yeah, what drove me was ultimately I felt like I was not seeing the value from the firm I was at, Morgan Stanley at the time. They were just taking an exorbitant amount of the revenue, I felt. And I would see product managers strolling through and going to steak dinners. And I'm thinking, geez, I'm here every night on weekends. I'm busting my butt, and I should be creating more value to myself. And so that was one kind of thing. And I think there was a right level of naivete just to think that I could pull this off. I did believe that I had a small number of clients. I was hopeful that they would come, because I had to hit kind of a minimum for the custodian platform to start the RIA, which I was able to do. But I felt that they would come with me, and that I had developed enough trust with them that I could be their advisor for kind of a long time. And so for me, it felt like the technology wasn't great. I was just told, like, my mother-in-law has an expression. She says to my kids sometimes, you get what you get and you don't get upset. Have you heard that expression?
I have. My daughter reads a book where that line is repeated frequently.
Yeah. Okay. So that's how I felt then. I was like, this is what you have, and deal with it. And to me, it just felt like there had to be a better way. But I didn't have any capital backing, so I bootstrapped it. I Craigslisted an office from an estate planning attorney. I cold called Fidelity at the time. They were our only custodian. I called to get some compliance help, and I just thought that there'd be other people that would want to join. I named the firm. It's a Latin phrase. It's Claro Advisors, and it means to make clear in the mind. And I felt like not only was I trying to do that for clients, but I was trying to push advisors to challenge the norms here. There are other solutions out there. So I purposefully didn't put my name on it. I knew that there'd be other people that might feel the same way. I've always been a team sport guy. I like being around other people and collaborating. And I did have a good friend And credit to him, he said, if you put this together, I'll come with you. And so just a couple weeks after I did, we talked and I said, it's up and running. He came and Dana was our first, he's still with us. And then a couple of months later, another guy I used to work with called and said, hey, I'm at this bank and it looks like what you've done is interesting. And I said, we like it if you'd like to give it a try. And so he came, his name is Mike. He's still with us. And so teams started to get put together. I met someone in 2014. So I was 2 years in at that point, and I was doing legitimately everything, not only as an advisor, but just all the stuff that you have to do to run the business. And it was becoming too much, especially the compliance. And I think nowadays, like starting an RIA, the threshold is so much higher. That's why you see, better than anyone else, you just see a lot more tuck-ins. But Jen Street was someone that I met, and she really allowed me to catapult the business and scale it. So she took over all the operations and compliance, and that really freed me up to be an advisor. And I really was just an advisor, kind of moonlighting as someone running. I would recruit a little bit, or just be kind of introductions, very soft. All that has changed based on what we've done in the last couple of years.
Amazing. So on the kind of thinking about risk spectrum, obviously now if you look back and say, hey, I had 30 million or whatever it was, like I didn't have anything to lose, right? But when you're in it and you had income, you had recurring revenue, you had a paycheck versus the dynamic of I'm going to incur a bunch of expenses. I'm not positive who's going to come with me. I'm not going to have a paycheck for a period of time. Did the fact that your business was relatively small and you were just getting up and running, do you think it made it easier for you to reconcile that risk? Or in some ways it was harder because your dispersion, if someone didn't come, was that much higher?
I think it was easier for me. I knew I could always go to another firm. They would take me and my whatever clients I had. I did it at a time when I had little personal risk, no kids, no mortgage. I had a wife at that point. So for me, it felt like the right time to take a risk. And I had been entrepreneurial in my life. I mean, I had a business in high school, and my parents and grandparents were entrepreneurial. So that was in me, even if I didn't really recognize it, was that I was okay with a good level of risk. And I do say this now to anyone that I'm hoping to partner with, is that if you want to bet on yourself, I'll go all in on you too. But you've got to be able to willing to take that jump. I won't let you fail, but you've got to be the one. I think that inertia is what a lot of advisors are kind of like, geez, I don't know, like I got to give something up. And that's why the data is important. And you have all the data, the clients overwhelmingly go with the advisor these days. It's just much harder to try to establish a new relationship with a trusted advisor than it is to just DocuSign some forms and move your account somewhere. So to me, it's just trying to support people and really push them to the edge and say, this is possible. You should definitely explore this. And I get it's totally different. You might be at a different life stage, but the numbers. I mean, tens of thousands of advisors are moving every year, and not all of them have a small book like I did when I did it.
Right. Exactly. On one hand, making this entrepreneurial move as early in your career as you did, it was a benefit, right? Because you didn't have as much to lose. Like you said, the stage of life you're in allowed you to absorb more risk. On the other end of the spectrum is someone who has a massive business with immense value. They're well situated financially. Maybe their kids are through college, et cetera. And then most people are somewhere in the middle. So it's interesting hearing that dynamic in real time. Well, let's talk about Claro today. So you launched the business, like you said, you have to work hard to meet a minimum custodial threshold. So started from a very small base in 2012, but where is it today as far as assets, team size? Just give us some stats or perspective on what you've built in the last decade and a half or so.
Yeah, sure. So we enjoyed a tremendous amount of organic growth, Louis. We are not capital backed. We don't buy books of businesses. So I would recruit or partner with advisors that were coming from all the various places that you could think of, that were finding us to be a very friendly place to work, where you had a high level of autonomy, freedom, control, just great economics. We stayed out of people's ways. We were just good people trying to help other good people. And it was just that friendly environment that allowed us to grow. And of course, we can't discount market. I think markets had a tremendous growth for everybody in the business. And so the business as it stands right now, we're about 1.5 billion in assets, 15 to 20 advisors. We got a 40-person team based primarily at a Boston headquarter, but we have advisors all over. And I think, as we'll get to, we've just gone through a really exciting new chapter for us, where the next 15 years, are going to look a lot different than the previous 15 years.
Very cool. I think that's amazing. And like, I'm in the recruiting business and doing recruiting yourself. Like, it's not easy to tell your story, get in front of the right people, the right like-minded people too, who are willing to take the leap to you, especially if you don't have the capital backing and you can't pay big deals or write big checks like others could. So that's a massive testament to you and your vision. I know the average age of an advisor at Claro is around 40, yet the average advisor in the industry is 59, 60, 61, depending upon what data source you look at. What do you think you figured out about attracting, training, and really cultivating younger advisors that the rest of the industry either gets wrong or ignores? Like, what's been your hack in that regard?
I'll just take a chance on people that others might not. And typically what that really means is I'll see someone with nothing. I'll make them a deal and I'll say, look, I believe in you. I think you'll be a great advisor. Let's work on an arrangement where you feel like you can do this and I'll support you. And so our specialty was growing advisors from or 20 million or 30 million into hundreds of million of client assets. And some of it was just being willing to look where others wouldn't possibly want to spend their time. But when I was 22, someone took a chance on me. And so I owe it to the next generation to do that as well, because there's some great talent out there that really just isn't getting the attention they deserve because they don't have big books of business yet. But one of my core values is long-term thinking. And so that's the way I frame my decisions is it doesn't have to be a win today, but it can be a championship tomorrow or down 3 to 5 years from now. And so that's how I've positioned it. I think that's why we tend to get younger advisors. And then what happens when you get a lot of younger advisors? You have some older advisors say, hey, look, that's an attractive bench of talent. I need a succession plan. You guys seem to have a bunch of guys and gals that know how to do really great work and serve clients. But I think that's probably one of the things that I just was willing to take some chances on people at an earlier stage.
Yep. I love it. I mean, once again, you said in the beginning, like you developed an empathy for the emotional side of money and what people were going through that you carry through to this day. So not losing touch with the fact that you started. I mean, everyone starts in this business at some time, but I feel like once you're successful or you're through the first few years, you forget what it was like to be a newbie. So keeping that perspective and appreciation for the mentors you had, et cetera, is great. And like, honestly, from a business building standpoint, to me in this environment, unless you take on private equity capital or you have capital from a BD or from a wirehouse behind you for recruiting, it's really hard to win advisors with large books of business. So going in the blue part of the ocean instead of the red ocean, if anyone's read that book, is very smart. Like looking under rocks that others don't, or really buying into or leaning into folks that you see something in that you know you can cultivate is a brilliant way. And it's honestly more scalable, cheaper. You build a better business as well, doing it the way that you do. But still, it's hard. And my guess is the ROI is shorter. I'm sure you've made some hires that don't pan out. So you have to have kind of the tolerance and the demeanor to really invest in people. So long-winded way to say, I love what you're doing. How much of your recruitment of advisors and the retention of that talent as they become successful would you tie to how you compensate them or equity if that's available versus the culture of the firm and the mentorship that you and your team provide?
Yeah, I mean, I'll speak to what we're offering now just because that's more relevant. And so we are positioning ourselves now as the best home for advisors in the country. And we really believe that's the case. But our problem is we're just a secret. We've just come to the market after our deal and all the technology that I know we'll talk about. So we're now marketing this message to advisors that want to partner with us. Economics will help them grow. We have a really interesting growth program. We'll give them equity in Claro. I firmly believe that we should tie each other, just get in the same boat, so to speak. So our success is their success, but allowing them to operate in kind of a 1099 model, which I know is not a popular strategy. I know everyone wants to buy books and own the assets and own the clients, but I feel there's just tremendous amount of advisors that do not, and probably should not be monetizing their businesses so quickly. And so I'm trying to foster a home for those like-minded advisors that want the autonomy to own their clients, maybe even still have a brand, but partner with a firm that's got really credible technology, just unbelievable back office support, and a firm of the future so that they can grow at 10x to what they could have on their own, and then they could monetize. That's what we've tried to put together here with our partnership model.
Love it. Yeah, I mean, it is definitely like going against the grain a little bit, leaning into growing a 1099 model versus more of an acquisition model where everyone coming over as W-2s. So do you think about those trade-offs if when it comes time to raising capital down the line, or if you want to sell the business, or even just like an advisor wants to leave, like that would stink if that happened. How do you think about those trade-offs? Kind of the ability to let advisors keep control and ownership. And honestly, in my view, like probably win many people that you wouldn't otherwise versus the stickiness and the enterprise building abilities of owning the books of business.
Yeah, it's a paradox because I understand why you want to own the client. But that's a different business model. And frankly, I think it attracts different type of people. I had to really look myself in the mirror a couple of years ago. We had enjoyed a tremendous amount of success, high growth and all organic, growing at 30% more per year on a CAGR basis. We were just, nothing could stop us. But what happened was when private equity entered the space, everyone wanted to buy Claro. And to me, it didn't feel like, I did a lot of due diligence. I talked to a lot of firms. I didn't see any differentiation in the market, Lewis. To me, from a technology perspective, everyone was doing the same thing. They're using 6 to 12 different tools. We all know who they are. And now there's a bunch of AI tools they're layering on. And to me, it just didn't feel like that was going to be there was no differentiation in the market. But admittedly, I had a couple of friends who I'd brought in at very low levels of AUM that wanted to leave. And they said, look, I want to go to a firm that has more resources. And so I had to just make a business decision and say, where do I want to take this? And so it was only after some real adversity, because you get emotionally attached to these people that you've developed friendships with, and they still are friends, no doubt, but they can leave and they're not captive. So we have to plan for that at Claro now. And I think we've got 2 ways that we've done that, where it's really ties the advisors to us, but in a way where they want to be here because we have something that's really different.
I like it. I'm sure we'll get into that. But before we do, we'll get into what you're doing on the technology side, which is very cool and unique. How do you balance being an advisor and being a CEO? And like, what percentage of your time is advisor versus CEO? And has that fluctuated or changed over time?
Drastically changed in the last year, 2 years or so. So the first 10, 12 years, I was really an advisor first and foremost. That's inverse at this point. I'm strictly running the business. I have a great team here that deals with our clients, and I'll still attend client meetings and such, but I'm really laser focused on running the business, trying to develop new partnerships with advisors, running an engineering team, sales and marketing. So the change for me has definitely occurred, and I'll miss not keeping up with planning as much. I'm a CFP, but I just recognized that for me, I had to make a clear change and commit all my time to running the business. And so that's the decision that I've made.
It is a hard balance. I mean, there's some people that try to do both, run a business, be an advisor, be a rainmaker, and something breaks, right? You're not able to give all yourself to one thing. And then there's others that would much prefer to be an advisor over a business owner. Others who say, I'm over being an advisor, I want to be a business owner. So I think the cool thing about doing what you've done is you get to choose, right? Like some of it might be circumstances, but you really got to decide like which elements of the business you personally want to invest your time in. And you really push your chips in the middle of the table. So let's get into what you did in November of 2025. I read that you acquired a tech company of all things called NDVR. I've done this podcast for a while, speak to a ton of people. I can't really think of any advisor or RIA that's actually bought a tech company. So what made you buck the trend, buy a tech company, and not just license all the fintech that's available today?
Yeah, that was the decision I had to make, was, do I really want to be different, or do I want to just say that I'm different? And so I was fortunate enough to get introduced to a gentleman named Michael Simon about 18 months ago, 2 years ago. And him and I immediately could see that we were both trying to solve the same problem, and we had perfectly mirrored image skills of one another. So I had this deep wealth experience, and he had a deep tech experience. And sometimes it's just about timing in life. about catching someone at the right time. And I think we each caught each other at a really good time where we could see that coming together, we could create something really magical. And this AI wave was cresting. And I could see when I was talking to all the national PE firms or RIA firms about what people wanted to do, no one had quite figured out how AI was going to come into the technology mix. And it appears as though it's just going to be another add-on tool to everything else. And for me, I wanted to try to build something that was integrated, an all-in-one platform for an advisor so they didn't have to use a ton of different tools. And I thought, if you could do that, couldn't you have AI that's really much more rich and purposeful to help the clients? And so I felt like here's an opportunity to elevate financial advice throughout the country, really give it the clients all the value. And so what we've built allows advisors who are really good advisors to become super advisors because they've got this technology cape that no one else has that is allowing them to save a bunch of time and do all these really cool things for their clients. But it just felt like right time, right place. I had been through a little bit of adversity and I felt like taking another swing, just like I did 15 years ago, going for it. I've really never been averse to risk. And so this felt like it was too good to pass up. And so we went for it.
Interesting. So it makes sense on the build or acquire versus rent dynamic, like wanting to own the IP that makes you actually different. What does and did NDVR actually do?
Yeah, so everything's all integrated. So we've kept the Claro Advisors name. We feel like clients really want to know that they're still getting a person to deliver the advice. And so having the advisors name in our brand is important. But we have a Claro Intelligent Hub, and that's where it's an AI native operating system for the advisors. They spend their entire day in there, Lewis. So they're not toggling between 10 different Chrome tasks to perform all their business. And so what that allows them to do is not only it's CRM, calendar, contacts, emails, messages.
Wow.
But we also have all the portfolio information. So trading history, and we can do tax loss harvesting and factor-based investing. So we've got institutional grade portfolio management. And that's really what Endeavor had created through their R&D was the hyper-personalized portfolios where you have a customer's financial plan directly tied to their account. So there's never any delinking between the two. It's really sophisticated technology that we can provide to our clients. So that's all integrated as well. And so we've since continued to build upon that layer of integrated proprietary technology.
It's very interesting. And we have to imagine like part of you maybe now or in the future is like, okay, we built this amazing technology mousetrap for our advisors, but do we become a fintech, right? Is there any thought of eventually licensing what Endeavor is doing for your business and your clients to other RIAs? How do you think about that dynamic of just building something unique and different for Claro that advisors can latch onto versus making what you and your partners have developed into something that someone else can take and license themselves?
Yeah, it's a fair question. We get it a good amount. And while there might be a possibility that we license this to some other businesses, our main goal right now is to keep it captive to RAs that want to partner with Claro. And so we feel like this gives them a true level of differentiation in the market. And so that's the approach that we're taking right now. Being a fintech company there's a lot of different skills, the setup and tear down of getting someone to use the platform. And I think all those, that time and resources we want on sales and marketing to try to attract new advisors and continue to develop just jaw-dropping technology for the existing advisors.
Very cool. Let's talk a little bit about your partnership model. So it does sound unique in that you have people that are 1099. You don't usually also hear partner. So how does it work?
Yeah, so we're offering advisors to come and use Claro as a back office. So you can have your own brand if you want, or you can just be a Claro advisor. We have both here. And you'll be a 1099 advisor. So you'll still own the business that you've owned. So if you were at a wirehouse or something, you would actually now be creating some enterprise value for yourself. But if you're an existing RIA, you'd be coming to us because you're tired of doing tech vendor due diligence all the time, or you're tired of the compliance, the AI regulations. That's just coming. So that's going to be a huge challenge for RIAs. So we're seeing a lot of interest from RIAs saying, look, you're not asking me to give up really anything except the stuff that I hate to do anyway. So this sounds great. So they partner with us. In return, they get all access to our technology, and we'll provide all the back office support, office space, dedicated resources, planning, everything you could want to have to operate a business. We do have this growth program that's really interesting. And then we've got this equity in Claro. And as you're a partner with Claro, you should get equity. So we give stock options to our advisors who are here and every year thereafter. And naturally, that's a way to stay connected with the advisor. So hopefully they never want to leave. And I do believe that once you experience our technology, you never want to go back to trying to do it the way you were doing it before.
It's like instead of building like the most enclosed box that you keep people in with sticks and with locks and keys, like a lot of firms do, it's we're going to keep advisors here, but not by force, but because they have the stock options, because you're delivering value, because they have this amazing technology. Like to me, that's the dynamic that so many firms across the industry get wrong, is that they try to keep advisors where they are by restrictive covenants and by fear and by retribution, rather than if we just do good work for people, we add value, we make ourselves indispensable to the advisor. To me, it creates a healthier dynamic. I think firms would actually retain more, even if it's a gentler approach. And I love what you're doing there. I think it's the exact right way to think about. We have advisors that are 1099. So yeah, they could leave us, but we're doing things that make it that they don't want to leave us. And that's your charge as the owner to create the infrastructure and the structure where people could go out on their own, but there is an advantage to do so.
I think the culture is a big thing for us. And if you have people here that don't want to be here, that's a problem. And I think that's what you see in a lot of the wirehouses. Frankly, they scare people and they don't, it's like, oh my God, if I leave. And for us, it's like, personally, life is too short. I want to work with people that want to work with me. I've got other things going on in my life, and these things are just work things. And so like I want to enjoy being in the office every day with people that want to be here. And if you think you've found a different place, you should go explore that. It's really a soft approach. I know it's not the most popular approach, but that's just the style that I have.
Yeah. I mean, it sounds like the trend in your career and in launching Claro was we're going to do things that aren't popular, but that work for us, like hiring younger advisors that may not have a book or have a small book, buying a tech company instead of licensing it, being 1099 when you're recruiting instead of owning books of business. There's a series of decisions you've made as the business owner that they've worked out, they've paid off, but they're definitely against the grain. And I very much respect that.
I really have never been afraid to be a little different. And so I think there's typically you find other people that might be interested, but it's a big pool out there. There's 300,000 advisors. So there's something for everyone, which is awesome.
Totally agree. Let's get back to the AI platform that you've built or that you're building. Maybe give like a real tangible example. Like if I'm a Claro advisor, how has my life changed now that I'm using this platform versus before? So the old model was I log in, like you said, to 10 different Chrome tabs. I'm meeting with clients, doing planning, et cetera. What is the day in the life? Like, how does it look different from what an advisor is actually doing today versus before this platform was rolled out?
Yeah. All right. I'll just give you a couple like examples. So we have a client will send you a request and say, Lewis, I need $25,000. And so a typical advisor would either write a note down, go drop it off at the CSA's desk, or maybe forward that email to the CSA. And then that person would have to input it into their CRM and then go perform the task. And then the advisor would want to know where things are in that process. So that there's a lot of back and forth. With our system, Claire, our intelligent chief of staff, AI chief of staff, you just forward that task to tasks@claroadvisors.com. It recognizes the email address that the client is emailing from. It knows the account number. It talks to our portfolio engine. It knows which account to raise the cash from because it knows the tax jurisdiction and otherwise. And it performs the task. And the last push of a button is that CSA just moving money from the custodian. So all along the way, the advisor can check on the task and see where it is in the process. It's beautifully integrated in the Intelligent Hub, but you could see how that would save a tremendous amount of time, and it's a better customer experience. The mistakes get limited. So it really allows the advisor to get things done at a much higher level. So we're raising productivity quite a bit. She'll prep she'll establish your meetings, Claire will. So she'll schedule them for you. she'll prep them for you. So we have a button, she's prep the meeting because we have all the notes, emails, if you're texting, portfolio data, because she has all that information. In about 30 to 45 seconds, she's going to present to the advisor a really nice meeting summary that, hey, here's the things that we should talk about. She's going to surface things that the advisor's forgotten about because she doesn't forget things. And so she's prepped the meeting for you. So you've saved a couple hours there. She joins the meeting. She takes all of your notes, it stores them in the system. She'll give you a follow-up email. She knows your writing style. So she'll know that you like to call this client this, and you send these emails typically at this time. And so she'll deliver a nice follow-up email instantly for the advisor. They click that button, that's done. So there's just a lot of things that where she's efficiency-wise, we're on 20, 30 hours a week that we're saving advisors just on the productivity tools alone. So that's where we're seeing advisors seeing a ton of value in this.
It's very cool.
And then there's a whole portfolio management capabilities, sweeping idle cash and tax loss harvesting and rebalancing that gets done while advisors are having a cup of coffee. They don't have to think about these things. It just gets done for them.
It's so cool because it's like, I think I can conceptualize or think of like building in Claude, any one of those functionalities for the most part. But the way that the flow of things works and the journey of it is unique. I think every advisor would be interested in that type of promise of saving that much time. So how do you think now in the future, how do you think about the human advisor interaction and what the human and the advisor will do versus what can be offloaded to AI?
Yeah, certainly a lot of the non-client facing activity can be unloaded. And that's where advisors spend, according to recent studies, almost 60% of their time non-client facing. So we're trying to take all that off of their plates for them. We strongly believe clients still want the message to come from a person that has a level of experience and understands them. But at the same point, I think there's a growing kind of curiosity about, hey, geez, what could it do for me? And so shouldn't my advisor know how to use it? And so I think you're seeing a lot of advisors put their head in the sand and say, I don't know, I'm just going to hope people don't really want to use this and adopt it. They're a little bit short-sighted there. Our bet is that clients are going to want an advisor that knows how to use tech, has really sophisticated tech, but it isn't just another tool layered on top that now my data is in that tool. The reason our system is so beautiful and integrated is because it captures everything in a structured and secure way. So all of the compliance is in there. We whitewash all the PII, that's sensitive information. So we're not layering another tool on. Because it's integrated, we have an AI governance committee that really takes it seriously. Like, how are we using this information? And so we've got an approach and we've got guardrails around what it can do and what it can't do. Might there be a generation, Lewis, that wants an AI advisor? I don't know. That could happen. A twin, a digital twin where you say, look, I want to talk to Lewis. It's 10 o'clock at night. He might be in a different time zone than me. He's got little kids, but I do have this question. And so we're iterating ideas on how we can surface that for an advisor. So the advisor will 24/7 without actually having to be available 24/7.
It's amazing to think about. I mean, obviously you're deeply in this, like you have a front row seat into the power of AI, how it's transforming your business, like doing due diligence on acquiring this technology. 5 years from now, 10 years from now, what does the industry look like as a result of AI? What's your big bet?
A lot of the big firms are going to try to figure out how to layer in tech. It's going to be very difficult to do that. It's built on extremely old legacy technology. They'll be slow. They'll figure out how to do some things. What we're already seeing from advisors is the wow factor. Like, wow, I didn't know this was even possible. And so I think just given our size and where we are, we have an advantage that we can build things from the ground up very quickly. I mean, what used to take an engineer a couple of months or years can be done in a couple of days or weeks. So things have really sped up in terms of the development. It's much easier to build it than buy it. And so I think you'll see a lot of firms trying to do what we've done, really build proprietary technology. And I think there'll be a few winners that are able to do that. But being tech forward and aligned with someone who's thinking about it, I think is what a lot of advisors are going to want to be. That's the type of firm people would want to partner with, I think.
What about the dynamic of, like you said, the digital twin thing is equal parts cool as it is terrifying. How do you see, we'll say, the threat of AI impacting the profession of being a financial advisor? Like, do you look at it as like, is the entire pie is going to grow because everyone's more efficient? Or do you look at it as it's going to take out a lot of the advisor capacity we have because it's no longer necessary? Like, where do you fall on that spectrum?
So robo-advisors came and went. You remember those? I mean, not that they went, but they never took off the way that it was projected. They're still great businesses, but the human advisor won that battle. Clients do want an advisor, particularly at the higher end. And so I think at the lower end of the market, you're going to see some AI solutions where people are perfectly comfortable just talking to someone in AI, and they'll figure out if there's a hallucination or not. But I think there's definitely going to be a market for it. And so I think it just depends on where the clients are and what level of complexity they have. On the higher end, I do feel like the advisors will continue to have a huge advantage there. But we're building tools to give optionality to advisors. There might be some advisors who say, look, I'll charge half the fee that I used to charge. They can get my digital twin. And that's a win-win situation for everybody.
Yep, that's fair. So do you look at your competitive ecosystem now, not for recruiting advisors, let's say for winning clients? Do you look at like Farther and Savvy and different like AI or like fintechs as your competition? Or do you still look at it as like the wirehouses and other traditional RIAs?
I mean, Farther and Savvy have done a great job of going after this market. I think we're not as well known yet as they are. We've certainly built out, we think, is tremendous technology, second to none. There's a huge market of the IBD space that is just these guys and gals are stuck on these old platforms and things are like okay, but they're not super compelled to switch until maybe they see something like this. And so we have a massive pipeline of advisors, and I've been recruiting for a long time. I've never had a pipeline like this. So I know it feels different to me. Like people really are interested in this. It's enough for them to want to see tech demos and come visit us and really understand like, okay, this is a firm that is challenging what's possible. And that's someone that maybe I want to be aligned with. And so I think that there's a lot of places where we can get the talent. And so for us, it's just trying to find the right people that we want to partner with for the long term.
Very cool. I got two more questions for you. It's pretty remarkable that to get from where you started to now, the recruiting you've done, buying a fintech, integrating it, that you still don't have private equity investor or outside capital. Do you think that's on the roadmap, whether it's a certain size or you're looking for personal liquidity, or that the business will just need it because it's expensive to operate a fintech platform and to scale up and to keep growing the firm? Do you think there's a world in which you take on external capital to fuel your growth?
Most certainly. I mean, things have developed for us very quickly here, and outside capital and venture particularly is a space that we're actively in discussions with firms that believe in our vision, understand the value that we can create. And there's just no doubt that you have to have some wind at your back to get to the market. And so while we're not a household name right now, I'm confident in 2 years we will be. And our plan is to grow to hundreds and thousands of advisors across the country.
Wow. Big vision, but I love it. Last question for you. If you were 30 years old again, which I think everyone would kill for that opportunity, leaving Morgan Stanley today instead of in 2012, what do you think you would do differently knowing what you know now?
At that point, interest rates were near zero, Lewis. Valuations, you remember, were 2 to 3 times revenue. It felt expensive then. Obviously, things have changed quite a bit. So I would have begged, borrowed, and stole all the money I could from friends and family. Say, I need to buy as many businesses as I could at 2 times, 3 times revenue and pay, I don't know, 3% loan. Just in hindsight, that's what everyone should have done. That's not the path that we chose, but I think there's a huge opportunity in front of us to elevate financial advice across the country, make really good advisors even better by putting that super cape on them. And so we're very excited about the future, what we've got in store, and what we're going to deliver to the market. And it seems like just yesterday that I walked out of Morgan Stanley with very little assets and tried to start this RIA. But I'm very thankful for all the people that have been supporting me throughout this journey.
Amazing. I mean, that's a great spot to end, but let me ask the inverse of that question. Let's say you leave in 2026. So leave today, you're 30 years old, but you have the benefit of hindsight. You know what you know now. What would you do differently around the transition or building the firm? Other than, of course, be amazing if you can buy businesses for a fraction of what they cost today.
I would want to make sure that I've got an integrated solution. I don't want to be picking a bunch of different vendor tools. I know that's going to become way too time consuming for me. So I would really try to figure out how you can get something that's integrated, that can scale. But I wouldn't change anything about the people. I think you got to be able to connect with people that are like minded, and you still take the risk. What I can't believe, Lewis, is that people that sit at the wirehouses take a home team discount, and they're so fearful of leaving Morgan Stanley or Merrill Lynch or UBS. But why are they taking that? The market says you should be paid double what you're paid. And it's not just like that's 20, 30 years of data here that show that. And so I just would keep pushing people to bet on yourself. Your clients will come with you. Yes, that firm that you love will be the first ones to try to steal your clients. They're going to call them, and that's one-way loyalty. Another thing I don't understand, but that's the way the business is structured. I think there's a huge opportunity to just educate advisors about what's out there, and I would take the risk.
Love it. Ryan, this has been very fun. What you've accomplished, like I said earlier, gone against the grain at every turn, leaving like on the younger side without a huge business, buying and integrating a technology company, recruiting younger advisors without books of business. Every single thing you've done has been a different playbook. So I'm pumped to watch how we make Claro a household name and how this approach is going to pay off in spades. So I appreciate hearing this different perspective. And I know our listeners did as well. So much appreciated today.
Well, thanks for having me on. I know it's a long time coming. Thanks for your patience. I wanted to make sure we had something really exciting to talk about when we finally did this. And hopefully I can come back in a couple of years and catch up. And congratulations on everything you guys have built. You guys are just a premier name out there. It's been fun to watch your success as well.
Thank you, Ryan. I appreciate it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.